this is my review for the Common Final Exam for FRL 3000 class. So, what was this class really about? How can we summarize everything on, let's say, one slide or maybe in one sentence? In one sentence, when I thought about it, this class is really all about whether an investment is worth it or not worth it. Should we invest money into a new project or not invest money and reject the project? So to answer this question, is an investment worth it? What is the best method to figure this out? The best method which we were using throughout many of our chapters in this class was the net present value, the NPV approach, which says the following. To find the NPV for a project, we take the initial investment, which is a negative cash flow 0, negative, and then we add cash flow in year 1 divided by 1 plus R. Then we add cash flow in year 2 divided by 1 plus R squared, and then we keep adding all other future cash flows divided by the same parenthesis term 1 plus R raised to the power that matches the year of those additional cash flows. In general, there are 4 methods that we learned in this class that could be used to find out whether an investment is worth it or not. Those were the net present value approach that we just very briefly reviewed, the profitability index or the PI approach, the payback period approach, and the internal rate of return, the IRR approach. Those 4 approaches were covered in chapter 9 of our textbook. So, in the NPV formula that I just went over, what is CF1 subscript 1 divided by 1 plus capital R? What is that term? What does it mean? The answer is it's the present value of CF subscript 1. It's the present value of $1 amount or 1 cash flow. That was covered in basically the first important chapter in this class, chapter 5. Now, what is CF subscript 1 divided by 1 plus R plus CF subscript 2 divided by 1 plus R squared, and so on? So what is that longer term, like altogether? That's the present value of multiple dollar amounts or multiple cash flows. That topic, so the math, the time value of money calculations, finding the present value, finding the future value, and so on, of multiple cash flows was covered in chapter 6 in this class. Next question. How do we actually find all these cash flows? Cash flow 0, cash flow 1, cash flow 2, and so on, that we then plug into the net present value formula to evaluate an investment project. How do we find these cash flows? Well, we need to add together OCF, which is the operating cash flow, NCS, which is the net capital spending, and change in NWC, which is the change in net working capital. That was all covered in chapter 10 in this class. Next, going back to the net present value formula. One more thing that it has is the R. It's in the denominators. So what is this R thing? What is it? That's the required return, annual return for this investment project that we are evaluating. Usually, it's the firm's WACC, weighted average cost of capital, WACC. That part was covered in chapter 14 in this class. This is the WACC formula. Weighted average cost of capital equals E divided by V, that fraction multiplied by R subscript E. Then we add P over V, that multiplied by R subscript P. Then we add D over V multiplied by R subscript D, and also multiplied by, open parenthesis, 1 plus T subscript C, close parenthesis. So there are a lot of terms in this weighted average cost of capital formula. Let's see where some of them were covered in this class. R subscript E, what is it? That's what we call cost of equity, the cost of equity to the firm every year. How much the firm pays to its investors who bought its common stock shares. That was calculated using first the CAPM, Capital Asset Pricing Model formula, which was covered in Chapter 13. Or the cost of equity can also be calculated if a different set of numbers is given using the so-called dividend growth formula, which was covered in Chapter 8 on stocks. Then the weighted average cost of capital formula also has R subscript P. What is R subscript P? That's what we call cost of preferred stock. So this is another type of stock, slightly different from what we call equity or common stock. And preferred stock is the topic that was also covered in Chapter 8 on stocks. And finally, the weighted average cost of capital formula also contains R subscript D. What is RD? That's what we call cost of debt or cost of bonds, again from the firm's point of view. This topic, the topic of bonds, was covered in Chapter 7 in this class. Then what if this project that we are trying to evaluate using the net present value approach is an overseas project? Then there are additional problems that need to be resolved, such as dealing with the exchange rates and so on. That was all covered in Chapter 21 in this class. So, is an investment worth it? We are using the net present value approach. It's the best one from the 4 that we covered in this class in Chapter 9. And then all the pieces of this NPV formula were covered throughout the rest of the chapters. So this slide summarizes everything that you learned in this class. All the chapters that we looked at least those that are covered on the Common Fine exam, are, they're all, captured on this slide. And what we can do now, we can click on these chapter numbers that I have highlighted in yellow, because they're hyperlinked to other slides in this file where I explain what was, covered in each of these chapters. So let's do it in order. Let's start with Chapter 5. I'm going to click on it. Chapter 5, Time Value of Money with One Cash Flow. That's kind of my title of this chapter. We learned one formula in this entire Chapter 5. FV equals PV multiplied by 1 plus R raised to the power T. And we learned about compound interest. So let's look at Chapter 5 in more detail. We looked at the financial calculator. Texas Instruments BA2 Plus was the most recommended one. And we basically learned how to use the special buttons. They're all in the third row of the calculator. N, IY, PV, PMT. Actually, PMT was in Chapter 6, not Chapter 5. And FV. So these are the special buttons that we were learning in Chapter 5. They were first introduced in Chapter 5. And to summarize, we did 4 things in this chapter. First, we learned how to calculate the future value, or FV, for a single cash flow, for a single dollar amount that you, let's say, invest or maybe deposit in a bank account today. That's the present value, the starting point. So you need to enter in your calculator the present value, the dollar amount, with the negative sign, which you take care of by pressing the plus minus button on the bottom of your calculator. Then you enter the number of time periods, which is N, or T in the future value formula, the power. Then you enter the interest rate per time period, which is usually per year in most numerical examples. That's IY, interest per year, In the future value formula, if you use it by hand, that's the lowercase r. Then we also looked at so-called simple interest. With simple interest, money does not get compounded every year. So the interest you earn every year is always the same dollar amount, always based on what you started with at the very beginning in year 0. So the future value with simple interest cannot be calculated with the financial calculator. It has to be done by hand only using the following formula. Future value equals present value multiplied by, open parenthesis, 1 plus r times t. So t, the number of time periods, is inside the parentheses. It's not the power in the compound interest case. So you can see how the formulas are similar. Then we instead learned how to calculate the present value when the future value of a dollar amount of a single cash flow is given. We also then learned about how to solve for the implied interest rate when both the present value and the future value and the number of years in between, or time periods in between more generally, is known. And lastly, when we know the starting point, the present value, and the future value, and the interest rate per time period is given, then we can calculate how many time periods it takes for the present value to grow and become equal to the future value which is given. And this is where we use the rule of 72, a little bit for a couple of problems. It's basically an approximation, like a quick way of doing this type of financial calculator math. The time, but it's only for a special case, when we double our initial amount. So when FV is 2 times PV. So the time it takes to double is 72 divided by R. And R must be entered not in decimals, but the way it's given. So if R is 10%, you do 72 divided by 10 and get 7.2 time periods. And we also had, a few conceptual topics. So the higher the N, or the T in the formula, the higher the future value and the lower the present value. The higher the interest rate, IY, in the financial calculator, or R in the formula, the higher the future value again, and the lower the present value again. Okay, so this is chapter 5 summary. Let's click on the home button and it will take us back to the main slide, which is the overview of the entire class. Now let's quickly review what was going on in chapter 6. I'm going to click on that. Chapter 6, time value of money with multiple cash flows. So it's all about multiple cash flows, how we find, the same things that we were finding for a single cash flow in chapter 5. Okay, so with multiple cash flows, we were dealing with kind of 2 types of, sets of multiple cash flows. Multiple different cash flows, different dollar amounts for each, and multiple identical cash flows. For the different cash flows, we were doing the calculations of their present value using cash flow keys in the financial calculator, and the calculation of the future value, which actually can also be done using cash flow keys, but then you need one extra step. And I have another YouTube video on that if you want to take a look at it. Multiple identical cash flows include annuities and perpetuities. An annuity is when we have a cash flow repeating a number of times and then it stops. If it does not stop and keeps going forever, that becomes a perpetuity. For annuities, what kind of calculations were we doing? When you know the dollar amount of this recurring cash flow, repeating, that's the PMT. So PMT is for annuities. It's the dollar amount of what's repeating over and over. So when you know the dollar amount of the repeating cash flow, how many of those we have, that's the N. Then the interest rate that's earned every year, IY. then we can calculate the present value of an annuity or the future value of this annuity. Then when you are given either the present value or the future value of an annuity, the payment, the recurring dollar amount itself, the interest rate, you can also calculate how many payments there are. So compute N. You can also instead have problems which ask you to compute the payment amount itself when either the present value or the future value of an annuity is known, as well as how many payments there are and the interest rate. Or you can also calculate the implied interest rate, compute IY, when you know either the present value or the future value of your annuity, the recurrent cash flow amount, and the number of those repeating payments. Then we learned that annuities can be ordinary or due. Ordinary is the ordinary case, the default case. And that's when all PMTs, all recurrent payments, occur at the end of each time period. Due, annuities due is when they occur at the beginning of each time period. You can skip the math that has to do with any calculations related to an annuity due, because this topic is not in the study guide for the final exam. We also learned that annuities can be called growing. That's when the payment is actually not constant. It doesn't remain unchanged. It's growing at a certain rate. But you can also skip the math for these type of numerical problems. It's actually a pretty complicated formula. It cannot be done in the financial calculator, only by hand. Then what else did we do with annuities? We then applied the calculations that we learned to annuities in real life. Where do we see annuities in real life? Actually, in a lot of things. But in particular, we see annuities in loans, car loans, home loans, business loans, and so on. And then we had the topic on different types of loans. Pure discount loans, interest-only loans such as bonds, which were covered in chapter 7. And then we looked at amortizing loans. This is actually what we see in our life a lot. Amortizing loans include, for example, home loans when you buy a house, car loans when you buy a car, and so on. Within amortizing loans, there are different variations. We looked at 3 in chapter 6, with fixed principal payments, with fixed total payments, and with fixed total payments and a balloon payment at the very end. So this was all covered at the very end of chapter 6. Then perpetuities. We learned how to find the present value of a perpetuity, which is cash flow divided by R. We also learned how to instead solve for R when we know the cash flow amount and the present value of the perpetuity. And we can also rearrange this formula to instead solve for cash flow, which is PV multiplied by R. In real life, perpetuities appear in, for example, stocks. Grown perpetuity also in stocks. Stocks were covered in chapter 8. Then another thing, kind of very, very different type of calculations that we were learning in chapter 6, had to do with interest rate. Interest rates can be called APR or EAR. APR stands for annual percentage rate. It's the same thing as the nominal interest rate or what's stated or what's quoted. It doesn't take into account the fact that interest may be earned more than once within a year. And that's what the EAR, effective annual rate, does. So EAR, effective annual rate, can also be called the effective rate per year or the APY. That's what banks call it, annual percentage yield. So in the financial calculator, if you are given the APR and are asked to calculate the effective annual rate, or if you're given the effective annual rate and need to go back and figure out the APR, you start by pressing the button second, then you press 2, and then you plug in the information on how many times interest gets compounded per year, and the number that's given, either APR or EAR, and then you press compute for the one of the two that you need to calculate. The more often interest gets compounded within a year, the higher the effective annual rate. Okay, so this is the summary of chapter 6. Let's press the home button, and we are back at the overview of the entire course. Now let's click on chapter 7. Chapter 7 was on bonds. That's one way for companies and governments to borrow money. Bonds could have annual coupon payments or semi-annual coupon payments. For bonds with annual coupon payments, we were doing two important calculations: finding the bond value, or the present value, PV, and finding the bond's yield to maturity, YTM, which is basically the discount rate, IY, in the financial calculator. So for both calculations, there are 4 things we are working with. 5 things. 4 are known, and the 5th is what we are computing. To find the bond value, we compute PV. To find the bond yield to maturity, we are computing IY. For the calculations with semi-annual coupons, we are doing exactly the same steps in the financial calculator, except because there are 2 coupons per year, we need to make a few adjustments here and there. The PMT, the annual payment coupon amount, must be divided by 2. The interest rate must be divided by 2 if we are finding the bond value, and the number of years remaining until the bond matures must be multiplied by 2 to reflect correctly how many coupons we will have until maturity. When we are finding the bond yield to maturity, or the IY instead, when you get your answer in the financial calculator, that's per half a year, and so it needs to be multiplied by 2. The higher the yield to maturity, the lower the bond value, or the present value. And this impact on the bond value is higher when the bond has a longer time to maturity or a lower coupon rate. And this is called the interest rate risk. Then we also looked at different types of bonds. So just very quickly, are they corporate bonds or government bonds? Who issued them? Do they pay coupons or do they not pay coupons? Is the coupon rate constant, which creates constant coupon payments throughout the bond duration, or are they varying coupon rates for each year? Are coupons taxed or not taxed, depending on whether a company or a government sells those bonds? And then we also looked at the so-called Fisher effect, which says to calculate the real interest rate per year, you take the nominal interest rate per year and subtract the annual inflation rate. So the nominal interest rate is the YTM, the bond yield to maturity. That's the nominal rate. And we also had a conceptual topic called term structure of interest rates, which is basically 6 different things that determine the yield to maturity on bonds, on different types of bonds, corporate and government, depending on how many years to maturity those bonds have. So there are a lot of things that kind of are put together in this topic. And one example of the term structure of interest rates was specific to federal government bonds, called Treasury Yield Curve. That graphical relationship between a number of years remaining to maturity and the nominal interest rate on those government bonds. Okay, let's go back to the home page. Now let's review chapter 8 on 2 types of stock, common stock or equity and preferred stock. Let's click on it. Stocks, that's another way for companies to raise money. To find the stock price today, you need to discount all future dividends. So you need to find the present value of all future dividends, or the sum of discounted future dividends. We looked at 3 different cases. Case 1 was called constant dividend or zero growth dividend case. Case 2 was called constant growth dividend case. Case 3 was basically everything else, and we can call it non-constant growth dividend. So no one pattern of future dividends. For the constant dividend or zero growth dividend case, you can imagine a dividend remaining constant every year in perpetuity. To find the price of such stock share today, you need to take the dividend amount and divide by the R, discount rate. This is the same thing as finding the present value of a perpetuity, which was covered in chapter 6. This type of stocks is known as a preferred stock, same dividend every year forever. The second case, the second pattern of dividends in the future, is called the constant growth dividend case. This is where the dividends are growing at a constant rate every year in perpetuity. To find the price per share of such stock today, we take the very first dividend in the future, D subscript 1, and divide it by R minus G. G is the growth rate in the dividend amount every year. This is the same thing as a growing perpetuity, finding the present value of a growing perpetuity, which was covered also in chapter 6, just like a regular perpetuity. Then we treat this constant growth dividend case as the most common, real life case, pattern of dividends for a company that's getting larger, more profitable, and is able to increase how much money it pays in dividends per share. So we take this price formula and rearrange it to instead solve for the R, the interest rate that you earn every year if you are an investor buying shares of stock from such company. So the annual rate of return on your stock investment, R, equals dividend in year 1 divided by the price you're paying today for each share, and then to that fraction you're adding the growth rate in dividends. And you see how the return, or the total percentage return, has 2 components. It's the sum of 2 things. The ratio D1 over price is the dividend yield, which is in percent. And G is the capital gains yield. So G basically has several meanings in this chapter. Originally, it's the rate at which the dividends are growing every year. But it also means the rate at which the stock price is growing every year, which we also call the capital gains yield. The total percentage return on stock investment is also called cost of equity in chapter 14, where we do the weighted average cost of capital. The non-constant growth dividend case basically can have a lot of different examples. We covered 3 very different examples in class. Dividends are not paid temporarily, and then the company starts paying dividends and they're growing. So there is a constant growth pattern, but it's delayed. Then we looked at another example, which we can call a multi-stage dividend, where there is one stage with uneven pattern. Dividends are maybe growing, but kind of no pattern there, like at which rate they're changing every year. So an uneven growth stage. And then it's followed in perpetuity by a constant growth stage, where the dividends are growing every year forever at a constant growth rate. And the third case was called a supernormal, or a 2-stage dividend growth, where there are 2 clear patterns. one pattern over the first few years, very fast growth, supernormal growth. So G equals high percentage. Then followed by the second stage with a much slower annual growth rate of dividends. So a constant growth but a much lower G growth rate than for the first few years. So this is what chapter 8 was all about. A lot of computations, but everything is based on this common principle. To find the price per share of stock today, you need to discount all future dividends and sum that up. Let's go to the home page. Chapter 9. Let's look at chapter 9 before we look at chapter 10. So I'm pressing chapter 9. Chapter 9 was on four very different approaches to project valuation. So is an investment opportunity worth investing our money into or not worth it? The answer is, well, it's worth it if it's profitable. So how do we figure out, the whole profitability part? We do it four different ways. So that's our four approaches that we learned in this class. The textbook also covers a few more, some of which are just variations of some of these approaches, but these are the four most important ones. The net present value or the NPV approach, the profitability index or the PI approach, the payback period approach, and the internal rate of return, the IRR approach. The net present value approach says that the project should be accepted if the net present value is greater than $0. The profitability index approach says that the project should be accepted if the profitability index is greater than 1. The payback period approach says that the actual time it takes for the initial investment to to pay back, the actual payback is it must be less than the required payback, sort of our limit, how long we are willing to wait. And the internal rate of return approach says that the project should be accepted if the IRR is greater than the return that's required. So for example, let's say we want to invest $100 and it's a 3-year project that will bring us $40 each year. To find the NPV, we enter cash flow 0, we use the cash flow keys. Cash flow 0 is negative 100, how much we invest. Cash flow 01 is 40. We change the frequency of that to 3 because we have $40 repeating 3 times back to back. Then we press the NPV button. It asks us for the interest rate. Let's say it's 7% per year. You enter that, compute. In this example, you get the net present value equal to $4.97. How do you analyze this result? Well, because the net present value is above $0, this project is profitable. This is the profit we will earn, $4.97. So the project should be accepted. And then we looked at some advantages and disadvantages, pros and cons of the net present value approach. For the profitability index approach, so the NPV in more detail is then covered in the chapter that follows, which is chapter 10. For the profitability index approach, we do the same math in the financial calculator using cash flow keys, except the cash flow in here 0 must be entered as 0. And then we need one more step. The second step, when we find the NPV in the financial calculator, which is $104.97, we then divide it by the initial investment of $100. And we get a ratio of everything we earn in the future in today's dollars divided by how much we would need to spend today. So the profitability index that we calculate this way is equal to 1.0497. How do you evaluate this? How do you analyze this result? Because the number is above 1, we make more than $1 that per each dollar that we invest today. So the project is profitable and we should accept it. And then again, we looked at some pros and cons of the profitability index approach. Next, payback period approach. In our example, in which you invest 100 and earn $40 for the next 3 years, if you do the math, after 2.5 years, you earn exactly $100. And that's our actual payback period, 2.5 years. And we need to then analyze this number by comparing it to our sort of maximum number of years that we are willing to wait to get our money back, our $100 back. Let's say our required payback period is 3 years. So anything that pays back within 3 years would be considered as a good project. If that's the case, in this particular example, our decision would be to accept this project. We also looked at pros and cons of the payback period approach. And finally, the IRR approach. In this particular example that we are using for all 4 approaches, you do the cash flow keys again. You start by entering the cash flows the same way you would if you were asked to find the net present value. Except when you're done with entering all the dollar amounts, you then press the IRR button and then you press the compute button. The calculator will tell you that the IRR equals 9.7%. How do you make your decision regarding the project based on this result? Because the project generates a 9.7 return every year, and that's better than 7% that's typically required for these projects, this makes our project a good one, so we should accept it. And again, we looked at pros and cons of the IRR approach. So another thing that was coming up throughout, the 4 approaches as we were covering them was when we have more complicated problems in which we are comparing, let's say, 2 projects using a particular approach. What was coming up that could completely change our decision, accept or reject, is whether the projects are mutually exclusive or independent. Then we saw some examples in which, let's say again, we are comparing a couple of projects and we are using a particular approach, and then let's say we are using 2 different approaches or 3 different or 4 different approaches, and we have some sort of disagreement about what the different approaches tell us to do, which project should be accepted and which one should be rejected. When in doubt, which approach should we always trust the most? We should always go with the net present value approach. So the net present value approach kind of becomes the winner from these 4 approaches covered in chapter 9. And so throughout the remaining chapters in the class, we kind of focus on the net present value approach, which is in chapter 10. Okay, so let's go to the home page with an overview of the entire course. What's our next chapter? Chapter 10. It's all on NPV. And in chapter 10, we are focusing on how we actually find the cash flows that go into the net present value calculations. So let's click on the chapter 10 icon. Where do the cash flows used in the net present value calculations come from? Well, it's the sum of OCF, NCS, and change in NWC, which stand for operating cash flow, net capital spending, and change in net working capital. We calculate each of these 3 numbers for every year of our project. So this is generally how you would set up a net present value problem. Let's say it's a 4-year project. you need to find the operating cash flow for every single year, except you won't have it for year 0, because operating cash flow is like profit from selling the product, whatever product it is that your project involves. And we sort of look at profits as if they're collected at the year end. So end of year 1, end of year 2, end of year 3, and end of year 4, if year 4 is the final year of this project. Then net capital spending. Oh, sorry. Before we go to net capital spending, how do we find the operating cash flow? There were 4 different formulas that we learned in class. My favorite, the one that actually seems to be the most complicated one, but it saves you the most time on the other hand, is the so-called tax shield approach, which says sales minus costs. That difference is multiplied by 1 minus the corporate income tax rate. And then you add the product of the depreciation for that particular year for which you're calculating the OCF, multiplied by the corporate income tax rate. Typically, the sales revenue, the production costs, the corporate income tax rate are given. But typically, in the problems on calculating the operating cash flow, what's not given is the depreciation for that year. And this is where it becomes important to understand the difference between the straight line depreciation method and the maker's depreciation method. Next, net capital spending for each year. Well, technically, you wouldn't need to find it for each year, at least not in this class where we are simplifying a lot of things. Net capital spending is something pretty simple. To start the project, you typically need to buy something big, expensive, like a building, a piece of equipment, right? Maybe a truck, right? So some sort of what we call fixed assets. And so that happens in year 0, at the very beginning of your project. And then when the project is over, you sell it all used. In our example, that would be at the end of the 4th year, if it's a 4-year project. So you only need to calculate the net capital spending for year 0 and for year 4. For year 0, we label it as the initial investment. For year 4, we also call it the after-tax salvage value, which is calculated using the following formula. After-tax salvage value equals the sales price, the price at which you sell the asset used at the project end, plus the corporate income tax rate multiplied by, open parenthesis, the remaining book value at the time when you sell your asset, minus the sales price of the asset, close parenthesis. And here, again, to find the remaining book value, you need to understand how to calculate it depending on whether the fixed asset you're buying in year 0 for this project will be depreciating, losing value, using the straight line depreciation method or the maker's depreciation method. And finally, the change in net working capital. It could be something you need to calculate for every single year. And for the final year, it's always the sum of everything that was invested towards the net working capital, starting year 0. So the sum of year 0 through year 3, so everything that has been invested towards the net working capital is what will be recovered in year 4. As for the signs of all these cash flows, cash inflows, or the numbers with a positive sign, are typically all the operating cash flows, the after-tax salvage value that you receive when you sell your like equipment or building at the very end of the project, and the recovered net working capital at the very end. Everything else is what we invest, such as the initial investment in year 0 and all the net working capital investments in the earlier years, if we have that going on. Then, what do we do after we set things up correctly? We look at each year and sum up everything we have in that year's column. So in year 0, it's the sum of the initial investment and the net working capital, both cash outflows. In year 1, it's the operating cash flow and possibly also, the investment into net working capital. Same for years 2 and 3. For year 4, it could be up to 3 things: the last profit received, or the operating cash flow, the money which we receive from selling our used equipment and any other fixed assets, the after-tax salvage value, and any net working capital invested in the earlier years that we are recovering at the end of the project. So this gives us cash flow 0 for year 0, cash flow 1 for year 1, and so on, which we then plug into our financial calculator, cash flow keys, and in one step find the net present value of this project, given some discount rate. We also looked at a special case of net present value calculations, a so-called cost-cutting proposal, which is where you're not given neither the sales revenue for each year nor the production costs for each year, but instead you're essentially given the difference between the two, which is called savings every year. And so the operating cash flow formula is slightly rewritten as savings multiplied by 1 minus the corporate income tax rate, like in the original formula. And then, just like in the original formula, we add the product of the depreciation amount for that year multiplied by the corporate income tax rate. Then another thing you need to understand is all the numbers, the dollar amounts, the cash flows that we group together as operating cash flow for a specific year and so on. Some of them are called irrelevant. The others are called relevant or incremental. The irrelevant cash flows are only 2 types of cash flows: sunk costs, which already occurred before year 0, and financing costs, anything related to taking a loan for the project to pay for the initial investment. So if you see anything like these 2, you should cross them out. You will not use them anywhere in your net present value calculations. The relevant or the incremental cash flows is everything else, which, for example, also includes like this new term that we learned called side effects, which includes erosion and synergy. And those are the effects on the firm's existing projects, their sales revenues. So this is the overview of, the most important things that we learned in chapter 10. Let's click on the home button. We are back to the overview of the entire course. What's our next chapter? Well, let's look at chapter 13. Chapter 13 is where we learn about the cost of equity. The cost of equity, or from stockholders' perspective, it's the return that they earn every year, depends largely by the riskiness of the project's cash flows that are then used to pay the dividends on the stock shares that the investors are holding. So high risk, high return. The riskier something is, the higher the return that you're going to be rewarded with to compensate for that risk. We did the calculations for both the return and the risk for one stock and then for a portfolio of stocks. So a portfolio means, it does not mean, let's say, 2 shares of stock from the same company. It means stocks from at least 2 different companies. It doesn't matter if it's 1 share from each company or multiple shares. It's all going to be called a portfolio. For both one stock and portfolio stocks, we were doing 3 types of calculations. Expected return, E, and in squared brackets R. Then we were calculating risk. First, we would calculate the variance of returns, sigma squared, and then we would take the square root of that, and that will be the risk measure that we call the expected standard deviation of returns, which is just the Greek letter sigma. Same for the portfolio of stocks. For the portfolio of stocks, you can skip the calculation of the variance and the standard deviation of returns. These two are not in the study guide. However, the calculation of portfolio expected return is included in the study guide. When we do all these calculations, for example, for a single stock, you deal with things like different states of the economy and their probabilities, which could be equal or not equal. Same for portfolio of stocks, except we also deal with stock weights, which could also be equal or unequal. Then we kind of continued the whole portfolio analysis, and we learned about the diversification effect, which is the result that we saw in examples with two stocks in portfolio. And we saw how portfolio risk may be lower than the risks of the portfolio's individual stocks, which was kind of a very strange but a really cool result. Which then made us think that, okay, well, let's add a third stock, then a fourth stock, a fifth stock, and so on. Let's keep adding stocks, play with the weights of these stocks in our portfolio so that the portfolio risk gets even lower. And yeah, you will be able to do that, except the principle of diversification says that portfolio risk will never completely go away. You will never be able to get the risk equal to zero, which would mean zero variance, zero standard deviation. In other words, zero risk means perfect predictability of the returns you will get every year in the future. Let's say you get 11% portfolio return every single year, and you know that. That would be a zero risk, zero variance, zero standard deviation. But we will never be able to get this result, no matter how large of a portfolio, how many different company stocks we put into our portfolio. And that's because there's part of the fluctuations in portfolio returns that we can never eliminate. They're beyond our control. So we see that the total risk of a portfolio equals the diversifiable risk plus the non-diversifiable risk. These two types of risk can also be called, for the diversifiable risk, we use interchangeably the following terms: unsystematic risk, firm-specific risk, asset-specific risk, unique risk. Maybe you've also heard something called idiosyncratic risk, a very complicated word. It also means diversifiable risk. Non-diversifiable risk can also be called systematic risk and market risk. The difference is what kind of events cause the fluctuations in our returns. Diversifiable risk are fluctuations in returns that are caused by events that are unique to that specific company. Non-diversifiable risk is nothing but the fluctuations in the returns on our portfolio or on our stock that are caused by different events, more like big-scale events, country-wide events, like a recession, an expansion in the economy, change in tax laws, and so on. And because the diversifiable risk, the fluctuations caused in returns caused by firm-specific events, can be eliminated by the investor on his own by having other stocks within that portfolio that would offset any losses on that particular company stock in the same year. Because of that, we kind of, correct our high risk, high return statement and say high systematic risk, high return. So only the systematic risk, the risk that you cannot change, that you have no control over, that you cannot diversify away with a large portfolio, should be rewarded with a high return. And that takes us to the beta. Beta is a number that tells us how much systematic risk that particular stock has. And our benchmark is the market portfolio, or you can also rephrase and say an average stock in the economy. The beta for that is 1. If the beta of our stock is, let's say, 2, it means that when large events happen that cause the returns to go up or down, then relative to how an average company's stock returns would react to that event, our stock reacts twice as much. So it's like twice as volatile when the returns are are caused to jump or drop due to some large-scale events that affect all companies in the country. That takes us to sort of what is the exact relationship between the systematic risk and the required return. That's the capital asset pricing model, CAPM. So we have the systematic risk, or the beta, on the horizontal axis and the expected return on the vertical axis. Because we say high systematic risk, high return, the relationship is positive. And graphically, that's an upward sloping line called the security market line. The formula for the security market line is expected return, E square brackets R, equals R subscript F, which is the risk-free rate or the treasury bill rate, plus the stock's beta multiplied by, open parenthesis, expected return on the market portfolio, E square brackets R subscript M, minus R subscript F, the risk-free rate or the treasury bill rate again. The whole term in the parenthesis is also known as the market risk premium. So this formula calculates for us the required return given how much risk, systematic risk, that particular company stock has. From the firm's perspective, the return on stock is called cost of equity, and that was then covered in Chapter 14. Okay, let's go back to the overview of the entire class and then go to Chapter 14, where the cost of equity becomes part of a larger formula, the weighted average cost of capital. Chapter 14. It basically says that the required return on a new investment project is determined by how the money for this investment project is raised, where the money is coming from. So the discount rate, which is the focus of Chapter 14, is typically calculated by the weighted average cost of capital formula, which I already reviewed earlier. It has cost of equity, RE, cost of preferred stock, RP, cost of debt, RD. Cost of equity can be calculated using two different formulas depending on what you are given. You can use the CAPM formula from Chapter 13, or you can use the dividend growth formula from Chapter 8. Cost of debt is cost of debt is the same thing as solving for the yield to maturity on a bond, which was covered in Chapter 7. So can we always find the WACC and use it as the discount rate for a new project? Only when that project has a similar risk level to the risk level of the firm's existing projects. Otherwise, we cannot use the WACC as the discount rate. Instead, we can use the so-called divisional cost of capital, or we can use the so-called pure play approach, or instead we can use the so-called subjective approach. Then because we are talking about raising money that for the initial investment of a project, it actually costs money to raise money. That's flotation costs. Flotation costs make us sort of oversell new shares of stock or new bonds that would bring us money that we will use for the initial investment. And so the true initial investment should equal how much we need divided by 1 minus the weighted average flotation cost. That will give us a little bit more than what we need for the project, but it will give us the correct initial investment for year 0. The weighted average cost of capital has its own formula, which says F subscript A, the weighted average flotation cost, equals E over V, the weight of equity that we are raising, multiplied by equity flotation cost, FE, plus the weight of preferred stock, P over V, multiplied by preferred stocks, flotation cost, FP, plus the weight of debt, D over V, multiplied by the flotation cost for debt, FD. Let's go back to the home page. So what's left is chapter 21. What if it's an overseas project for which we want to find the net present value? Let's click on it. So how should we calculate the net present value for an overseas project? Well, we should still be doing the same math. NPV minus initial investment in year 0 plus all future cash flows discounted correctly back to year 0. Investment in year 0 for an overseas project is not going to be some dollar amount. It's going to be in a foreign currency. So to bring it into dollars, we need to use today's exchange rate, also known as spot exchange rate, denoted by S subscript 0, to convert the foreign currency into dollars. We can also do the same conversion for all future cash flows, but we need to, calculate the future exchange rates first. Well, the best we can do is estimate what they're probably going to be. So we use expected future spot exchange rates, and we are using the formula called the relative purchasing power parity to convert future foreign currencies into dollars. The formula we learned that calculates the expected spot exchange rate for year 1, year 2, and so on equals S0, today's spot exchange rate, which is how many units of foreign currency gives $1, multiplied by, open parenthesis, 1 plus the difference between the foreign inflation rate and the domestic inflation rate. The notation we used for the inflation rate is lowercase h. To estimate the exchange rate 2 years from today, you use the same formula, but for the parenthesis term, you raise it to the second power, and so on. Now, as for the discount rate, because we are dealing with a foreign project, if we are using the foreign currency approach to calculating the net present value, then we need to use the foreign discount rate. In class, I covered 3 different cases. You can calculate the foreign discount rate if you're given the discount rate for similar projects in the USA, and then you add the difference between the foreign country's inflation rate and the US inflation rate. Or you can take the discount rate in the USA and add the difference between the foreign and the US risk-free rates. Or it could be that the foreign discount rate is already given to you. So you just plug it into the NPV formula or the cash flow keys. Now, the first 2 scenarios for finding the foreign discount rate make it obvious that the difference between the foreign and the domestic inflation rates equals the difference between the foreign and the domestic risk-free rates. This could be rewritten as the US risk-free rate minus the US inflation rate equals the foreign risk-free rate minus the foreign inflation rate. This is the so-called international Fisher effect. On each side of this formula, we essentially have the real interest rate when they're adjusted for inflation. So the international Fisher effect says that the real rates equal across different countries. Then we also had, so let me just, repeat again the relative purchasing power parity formula that we can use to, calculate what we expect about future spot exchange rates when we know the inflation rates here and overseas. Then we also had an interest rate parity, and we call it approximate, which says 1 year forward rate F subscript 1 equals today's spot exchange rate S subscript 0 multiplied by, open parenthesis, 1 plus the difference between the foreign country's risk-free rate and the US risk-free rate. Comparing these two formulas, the relative purchasing power parity and the approximate interest rate parity, you realize that they're very similar, and the difference between the inflation rates is the same thing as the difference between the risk-free rates, and we already had that covered in the international Fisher effect. Then what is the exact interest rate parity? It also starts with 1 year forward rate F1 equals on the left-hand side. And on the right-hand side, it's a little bit more complicated than the approximate version of the formula. We have spot exchange rate S0 multiplied by 1 plus foreign country's risk-free rate. And then the whole thing is divided by 1 minus the domestic risk-free rate. Another thing that is true for the relative purchasing power parity and the approximate interest rate parity, if you compare them side by side, is that the expected spot exchange rate in 1 year equals the 1 year forward rate. This equality between these two things is known as the unbiased forward rates. Then other calculations we did in chapter 21 was calculating the cross rate, or the implied exchange rate between two foreign currencies, when we know the exchange rate between each of the foreign currencies and the US dollar. We also had the absolute purchasing power parity, which calculates the price for a specific commodity, let's say a burger or a laptop, in a foreign country when you know how much it costs in the United States and when you know today's spot exchange rate. Other terms that came up were Euro bonds, foreign bonds, LIBOR, London Interbank offer rate, spot versus forward exchange rate, knowing what it means, like in which case we say that a currency appreciates or gets stronger or sells at a premium relative to some other currency. And we also covered the topic called exchange rate risk. Okay, so going back to the overview of the course, these are, all the chapters that we have reviewed. Chapter 5, Chapter 6 on multiple cash flows, Chapter 7 on bonds or debt, Chapter 8 on stocks, Chapter 9 on different methods to figure out if a project is profitable, Chapter 10 specifically on how we get the cash flows for a project, Chapter 13 on stocks, in particular what stock return is determined by, Chapter 14 on weighted average cost of capital of a firm, which can be often used as the discount rate for a new project if we use the net present value technique. And Chapter 21 was kind of a step further NPV for a project which takes place overseas. Well, I hope this review was helpful to sort of, get a big picture of everything we did in this class. And last but not least, good luck on the Common Fine exam.